Welcome, everyone, to the Kendall Report, where I share my 45 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. And Todd, yes, I did catch it, and I hope others did as well. These data sheets are becoming very interesting. I've got a couple of tweaks. I made some notes that I'll maybe discuss here on the channel tonight, but I've got a couple of tweaks I want to make. Anyway, you know, I put it out as, tariff tantrum 2.0, and it looks like we're getting into some pretty interesting scenarios. China's definitely lashing back with the rare earths and shipments out of Hong Kong, all kinds of stuff. And where does this go? I don't know. I mean, what's the desired outcome, from the Trump administration? I'm unsure of that. I do want to discuss, before I get into some of these other things, I watched the Powell talking in front of the Chicago economic folks today, and yeah, my audio's cranked up. So anybody else having any trouble with audio? Let me know. Yeah, I'm going to go through that right now, Todd. I guess we're about 20-second delay here. Let me know if there's an issue with the audio. It looks fine on my end. Looks normal. So anyway, just to go on. Yeah, so I watched the whole thing with Powell, and I thought it was interesting because he does his usual pitch, and he always makes sure that he knows that lets us know he has a dual mandate, price stability and employment, and he just hammers that down all the time. That's all we do. What I heard from Powell's comments today was, I don't know, we don't know, I don't know, we don't know, we don't know yet. That's what I heard. It was like an echo chamber. There was a couple interesting exchanges that I thought were interesting. Is the acknowledgement of the immigration. They didn't say illegal immigration, but the immigration. They should have called it invasion, right? And that actually, Paul was saying that really helped. The economy of those people got jobs and they worked and they participated, and that was part of the cooking of the books of the Biden administration, right? That was part of what they were doing. It's just load everything in, add money, all that stuff. So it looked good. And what we're dealing with now is the aftermath of that. It's sort of like, like a hangover kind of situation where we're trying to get rid of all of the excess, everything that was put in. And, so he did make a comment that employment has stabilized, even though immigration has slowed, he said. I thought that was hilarious. But what he was saying, well, demand has also went down, and unemployment and employment has slowed as well. So they're equal. That's why the unemployment numbers are so stable over the last year or so, he said. I thought that was fairly interesting from the standpoint of things. But what I heard was, and it's what I've been telling you here, is that nobody knows what the effects of the tariffs are and what they're going to mean. It's going to take months on end. And he kept saying, well, we don't know. They even had the guy that was interviewing him brought up the term uncertainty. What do you think this means, uncertainty? And volatility and all of that. And I think what we're seeing, it could have been the Trump tariffs. It could have been a magnitude of different things that could have come into focus, but the markets were ready to correct after, 2 years up, 52.5% compounded rate of return. It's time for a correction, right? So we got our 21%, and the title of this YouTube video tonight was, are we going to make new lows? And it doesn't look like that. I'm going to go through the technicals. I'll go through the typical stuff that I go through every night, but we'll look at the weekly configuration. We did see something that I talked about yesterday, which I'll unpack, and I believe I discussed it in the Substack newsletter as well. So if you don't have the Substack, that's where I do all the serious micro analysis, which is kendallreport.substack.com. $8 a month. I think it's $6.50 if you get a whole year for $80. Anyway, I didn't see anything that was material other than the same old gibberish out of Powell. And I was looking for something. I mean, the markets just were getting hammered today, right? So just going through the general sense of what was going on, all of the technicals, everything I talked about last night just kind of implode, just came on top of the market. All of a sudden, the tariffs are back into focus and all of that. The question is does this get out of hand? Tomorrow is the final trading day of the week because of the holiday on Friday. So we will, we'll see if folks want to hang on to this thing. Overnight so far it's been pretty boring, kind of trading in a range. So nothing to look at like what we were seeing last night. We were already seeing, I think by the time I came live, we were already down 1%. And, definitely from the infrastructure around this market right now, there isn't any. I continue to see a little bit of improvement in the liquidity. A lot of folks talking about the VIX. I don't really pay much attention. Sorry. It's just not important for me to look at the VIX. I know a lot of folks do. It's, in my opinion, very kind of retail focused. I don't really, I pick up all the things that are happening in the VIX most of the time beforehand because of the database, which is my focus. So I have my own little world that I live in, and I will continue to stay there. It's treated me well over lots of decades. So, I don't really have anything else to add from that standpoint. I think that the tariffs are going to continue to be the story on the street, and they're going to continue to cause a lot of volatility. And there's a lot more downside than upside right now, but I think even the downside will be controlled. So I'm hoping that by the time I get done in my opening comments that the database will finish running. I was looking at it, everything's running as we speak right now, so it should be finished here in the next 10 minutes or so. So one of the things that I did also pick up from Powell was I think they asked if there was any way that the Fed put was in place, and he woke up. Absolutely not, he said, right? There's no Fed put. Absolutely, exclamation mark, if I recall how he said it. And I thought that was interesting. I've been telling you folks, the Fed's not showing up for anything. They're not going to help Trump, okay? Paul hates Trump. Trump would take him out if he could, and he knows it. And but they're not coming. And there's no reason for them to come either. And they also discussed one last thing on Powell Talk. They also discussed the balance sheet and why they slowed the balance sheet. And the interviewer was trying to dig a little bit and say, well, were you guys concerned that all this stuff was going to be negative? You want to have more money, on the side? And he said that they considered pausing it. And just because of probably just that, they don't know what the uncertainty is going to be. But I think that in the end, like I said in my beginning comments, all I heard was, we don't know, just like an echo. And no one knows this. They even talked about AI, which was even funnier, I thought. Anyway, so enough about Powell, but I think we look back at these markets and the scenario we're in, and I talked about this not just last week, but over the last 6 weeks or more now, is we've broken this market. The market's very, very broken. So we get little glimpses of the tech stocks rallying and all that. Then we get days like today, and it's just going to stay in this mode. And I'll show you here in the technicals. I don't think we have an immediate new low coming, but I think it's possible that ultimately we do get new lows later in the year. It may be after all the way into May or into June. We may have a little bit of a more of a summer sell-off. I think things are going to get, and we're going to have more information about what's really going on. You know, where does this situation go with China and the U.S.? I mean, that's really what it's about. I mean, yeah, the EU's there as well as the major economies and countries that we're dealing with. And, you know, I think Paul did make one other thing that I told you, and you should know, is that tariffs are not inflationary. Bear with me one second. So tariffs are a one-time bump, basically. You get it up, whether it's a 10% across the board or whatever. It goes up and it stops. It doesn't continue to go up. And so everybody that wants to have the narrative that they're inflationary, it could raise the cost of goods, but they're not. Oh, and that brings me to one last thing that happened. And he made it clear, this is very interesting, I thought, is that he was talking, the interviewer asked him about inflation. He goes, well, you know, we try to control it at 2%. Basically, he said, prices never go down. And I could show you, maybe I will bring that up here in a minute. But if you look at the pure price charts of CPI or any of those, not the year over year and the changes, because that's smoke and mirrors. The smoke and mirrors of the, I always say anybody that tells you how much money they're making in percentages that puts a radar sign up for me. You know, it's like some guys, I made 100% money, so he had $1 and he made $2. But in this case, he made it clear that there's no, he goes, well, we wouldn't want to embrace prices going down because you think 1929 deflation. So the system is rigged to always higher prices. It always flashes me to one of my buddies back in the 80s had a little lithograph on his wall, and it said he had a guy at a postal office and he was buying postal stamps because he wanted futures on postal stamps because they only go up, right? So he knew he was going to win because the prices only go up. Utility prices, once they go up, they stay up. Everything stays up. The only thing probably that has gone down over the years is like, you know, televisions, right? So there's been deflation there, but on the overall, maybe we'll take a look at that chart as we go through tonight. And so they just keep filling it up, and they live on this inflation. They try to make it sound like, well, this is good 2%. And we've averaged about 2%. There's a couple of things. Maybe I'll put something in the Substack tonight. I think that's a interesting situation. Let me bear with me a second. I just want to make a note to myself for the Substack. So yeah, let's go ahead and segue. Hopefully, let me look at the other screen here, see if we've got things done. Looks like that's done. Let me check out. And we'll go right to the WaveTech database and get into tonight. So it does look like everything is ready to roll. Absolutely. Okay, so let's go. So as we look at the WaveTech database, we were at 13 and change. I don't remember the exact number yesterday. 13 and change. We're now at 14.4%, well below the key 22% level I tell you folks to watch. We did get, I'm just going to round these numbers up, about 360 new buys versus 126 sells. So we do have slightly bullish ratio. So we're seeing a little traction. Let me just see if there's any. We have one sector which is now down to no new sectors coming in. So we've got conglomerates. No, consumer non-cyclical is long, but it's underwater after 2 days, about 2%. So it's not really following through, at least not at the moment. And that typically holds for like 36 days. These are the short-term models. Also, just so you know, tomorrow night will be like a Friday, so the intermediate models will run on Friday night, and that will get you Thursday night, and then you'll have the reports for next Monday. So the system knows the trading days. So anyway, we'll continue down. I think this very choppy range. We're going to have to get at least over 22 to show that we're stabilizing. I have a sense that we will, but right now we're just kind of in that no man's zone. I'm going to flip this over to the weekly numbers because I believe we're at let me look at something here. Yeah, we're at 1844 weekly, and we still have utility sector long. That's all we have. Excuse me. And so, so no traction in the intermediate, no traction in the short-term models. All that tells us is that we are locked at best in a trading range, which is great if you're a trader, because there some of these stocks that ebb and flow with these choppy ranges. You should be able to do some range trading, even selling some options around some of these ranges, doing some straddles and things like that, where you'll be able to collect a fair amount of premium in this kind of environment with not a lot of risk. And so anyway, let's I mean, you can buy gold up here. I see somebody's going, I bought more gold. Yeah, you can do that. Buy high, sell higher. It's okay. I mean, it's at a point that there's going to be an about face somewhere, but I think it could be another $100 or so. Had a big day today for sure. I'll try to get through that as we go through. So, so we're rolling along pretty good. Thanks, Steve. I was just looking up, as Steve was saying, that was the former. Yeah, I knew he was Indian, and I knew he was governor of India. I just thought I'd just summarize this since that came up. Is I think Powell has no clue what to do. I know he's anti-Trump. I know they're not going to put the Fed put up. They're not coming. So don't call them. The phone's going to ring and no one's answering. That's what's going on. And there's actually no reason for the Fed to be doing anything. And this, so anyway, I'll probably bring up the 10-year as well. So I'll bring in the little Fed stuff at that time. So let's go ahead and start to look at some of this. This is something that is being revealed just a little bit, and I talked about it last night. We actually were able to trade down below that 10-period moving average. If you recall, I was talking about the angle of attack and that the PPM1 was negative, and that was acting as a magnet to pull the prices down to that level and trend down. Now we're seeing, interesting enough, I'll put the cursor right here, the X right by this point, and we're seeing PPM1 cross through its second derivative, which is at least telling us that we're probably going to hold above the 10, but we've got a little mini channel forming, and it's going to be critical. We're going to have to close above R1 from the standpoint of that. I've already run the sheet, so I'll show you the fact sheet. I usually update them because the fact sheets are the data that it gets at that moment, that snapshot moment is there. I'll show you that. And I think that, it looks like there's a good chance that we now get sandwiched between the 10 and 21. And if we you notice also that this was a scenario that I painted out a week ago, actually, last Wednesday night, is that what we're going to get is we had this big wide. If we put the matter of fact, let's just do that real quick. Let's do a quick replay and come back into that range here. So let me do a quick replay on TradingView here, and this was the big blow up day. This was last Wednesday. It's coming. Okay, the next day. Okay, perfect. So this is what it looked like last week. And what I did was I drew in the lines, if you recall, and you can go back and watch last Wednesday. If you want to fact check me, that's cool. But what I did was I said, what we're going to see with this is we're going to get these lines to start to contract in here. So we're going to get these lines to start to contract in like this, is what I was saying. And then once we get here, which would be about a week from now, which would be yesterday or today, we then get to that point where we start to make a directional decision, whether it's going to go up from here or whether it's going to go down. And right now we have, let's get to real time here. We'll let this just flow. You'll see the pattern. You'll see the pattern just kind of come in, just like I was saying. It just starts to collapse in and gets very narrow, and then it forms this downward channel. So let me move that over so you can see it here. But now we have this bit of this forward funnel. If I can get this scaling right here. So now you get this collapse of volatility. Markets normalize after these big days. And it takes, like I said, it takes 3 to 5 days. It was exactly 5 days, 5 sessions. But now we have a little bit of a downward channel forming. So what does that mean? What it probably means at worst case here is probably trying to set up at least a bit of a right channel here from the standpoint of, so we get this move up here, and now we're setting up a right shoulder, and then we can find out, and I think we'll at least move back into these moving averages that are still declining substantially. So looks like we'll probably get some traction. Tomorrow's going to be an interesting day because it's the end of the week, so we're really looking into Monday, Tuesday next week, and then maybe we start to rally back in. By the way, we were unable in the last 3 sessions to challenge the 55.28 highs that was rendered a week ago Thursday. So we've been struggling around those numbers, but it looks like there's a couple key numbers here. Let me clean this up so we can talk about those, and then we can kind of move on here. So I'll keep this. So the lows that we made last Wednesday, take that back. This is Thursday's low and high. We had 55.28 and 51.46. Today, earlier on Wednesday, we had 52.51, and so far we're pretty narrow, and we're starting to see, let me bring the PPMs back in. We're starting to see that PPM 1's turning up, so we're probably going to trade up into the range. We'll see what happens from that standpoint. So let me bring up the, this is the fact sheet for, we still have a 70% bearish factor here. Right now it's got a 7 out of 10. It's interesting, oversold bounce is the category it's in right now. And if we look at some of the minor bullish movement on the is projected here, but the PPMs, as you see down here, are all in red, and these are down. So we're still in these big downtrends. But this PPM2 is the 21-day moving average. So that just tells you that's the ceiling. No matter what happens, that would be the rejection point. Right now, PPM1 is still at a 0.21, so it's still declining. It's still going to keep that price action heading that way. Looks like it's still short entry 53.25. This is trade recommendation, highest probability. And all it's doing right now on the trade recommendations, just so you know, it's doing S1, R1. So it's trying to sell R1. The 53.20, 20, it's got 25, so it rounded off. But it's just trying to sell R1. And it's trying to buy S2. And if you look at the alternative scenario is buy S1 and sell R1. So it's just looking at that probability range there. And I think if we look up here, volatility is moderate. So a moderate volatility is going to be R1, S1. Okay. Now remember, I programmed this thing to think like me. So it's just going, okay, we're looking at S1, R1. You should be able to play off those numbers. What you do with this sheet, okay, especially if you have the indicators, what you do with this sheet, you look for the trade setups, whether you're using a 5-minute or hourly, whatever you're using that you use if you're trading intraday. You look for the confirmation that there's a bottom at that point. You don't just blindly throw it in. There's been a couple nights off of I'm up at around the London Open every night. So that's always been a big trading moment for me. So you want to be a player off of that. If we're trading up at R1 when it comes into London, we typically get this little burst into the London Open. And then it takes about an hour or two before it'll reject. And I'm typically around for at least the first 2, possibly 3 hours of London. And there's a lot of good trading done there. New York folks start getting in, right around that time, 3, 4 a.m. Eastern time is a really good time to be trading. So if you're up and around, I've always envied those of you in London because you're like right there and it's early morning. You can roll and trade this stuff. So, but it's really like pristine trading environment. It's one of my very favorite. It's probably the other one is the U.S. Open, which I'm usually not around for. And but the bottom line is that's what's set up here from the data sheet. I will do a new snapshot of this. I'm trying to get a timestamp. Every time I try to get a timestamp on here, I don't know where, I can't figure out where it's grabbing the prices or the timestamp from. I'm working on that. But at least right now it shows this is the current trade. It was 53.09. Excuse me, look at the other. So it's now 14. It's a touch higher than when I took this snapshot. Okay. So let's go ahead and roll forward and let's go through NASDAQ. What time we're getting to be? 1/2 the hour. So yeah, I should be able to get through that. Maybe we can talk about stuff. I just a couple comments here. See, somebody's like, looks like it's grinding lower. That's what it's doing. That's that little, like I said, that volatility has just come to an end. Let's bring up the NASDAQ futures here just to get a good feel for that. And you can see this little downward channel that's forming. So we definitely have a downward bias, but all of these, the PPMs, the dotted lines that you see in the PPM are projected into the future. This is kind of echoing some of this movement here. It oftentimes will follow through, but this 21 period moving average this is PPM2, is remaining at a pretty extreme downtrend. So that's going to be a rejection line. Anywhere around STX or above there, you should see if the market's news, something spikes the market, you should be able to fade that spike pretty easily. especially if you're an intraday trader. As far as trading on swing trades, I don't see anything here just yet. And I would want to see the database on a short-term database get up over 22. I'd like to see a lot. I talk all the time about structure in the market. Well, structure would be also participation rates. And when our database is saying that it's at 22, it's at 14 right now, but when it gets higher levels, these are patterns that are recognized as high probability appreciation patterns. Doesn't mean they all will, but a material typically above 60% will actually participate, and that kind of builds your base and your function from cash flow coming back into the markets. And all we've seen so far is, cash money out, other than a couple spikes. Last, a week ago, Wednesday was 100% short covering. I mean, they demolished a whole lot of people there. I know some people say, "Oh, I caught it," but that's good. But most people lost. That was a scramble. It took them about 8 to 10 hours to work out most of the shorts that were in there. It's interesting because the order book, you can just see this stuff happening, and there weren't a lot of new buyers coming in, and that was my argument why the market wasn't going to follow through, because once you cleaned up all the shorts, took all that money, then you've got to do what we've done here, is grind this out, get the volatility to come down, and we're getting close. And probably everything's really pointing really toward the final week of April coming into May. We have a shot at, there's a shot at potentially seeing some appreciation from that standpoint. But it's just not, we're going to be locked in this range. These are going to do pretty good. I'm going to zoom out to the weekly, because this is another pattern I need to paint out for you. And when I tell you we're probably not going to get any new lows, we're probably going to trade this week. We may see a lower low next week and then follow through depending on how we trade. Like I said, we're coming into a long weekend. We'll see how people square up the books tomorrow. But this is the inverse pattern, or not the inverse. It's the same pattern, only on the next time series. So let me draw this in for you. So just like we had on the big spike on the daily a week ago on the daily chart, so this is the NASDAQ weekly, we're going to get this same type of pattern here that's going to see the market grid kind of come in, the same volatility pattern. I call it, it's sort of like if you've used, and I talk about this often, if you've used Bollinger Bands, you get that bubble. Well, that's a volatility bubble. That's on standard deviation. This is on just price, pure price range. So when you get that big week like we had last week, it blows up the volatility, and then it will contract back and normalize typically before it makes another move. It doesn't have to, but about like really high percentage, like 70-80% of the time, it does what I'm showing you here, just like it did on the daily. It has to do that same consolidation on the weekly level. So if I brought up the S&P, it looked the same way, okay? These two indexes are kind of cousins, right? Because they have a lot of the same symbols at the top end of the range, the S&P and the NASDAQ. NASDAQ just has higher volatility, higher beta. But the bottom line is you're going to get some kind of consolidation. During this time, you have, let me fix this thickness of this line. Also, during this time, you've got the 10-week moving average coming down in the pattern. That's going to be a rejection point as you go forward. Okay, so pay really close attention. simple 10. You don't have to get fancy with exponential and weighted and all that. You know, I know a lot of folks like to use the VWAPs and all that stuff. No necessity whatsoever. And maybe use it and it works. That's fine. But I just found this just simple averages work. And what we should see is the market start to trade in between these volatility ranges and come into this wedge. And then maybe, and now this puts us, I'm just drawing a straight line up here. This puts us in at the end of June, roughly, before that happens. So we've got the better part of 4 to 6 weeks, maybe. There could be some event that comes and just blows everything up. But typically, I'm telling you, 70, 80% of the time, this is what's going to happen. And what's beautiful about this, folks, if you're an index trader or if you're doing options, you can put, some out of the money straddles on here. Just take all the money. I mean, it's all yours. And so you should be able to range trade this pretty good for 4 to 6 weeks, I would think. But we'll see if I can come back on this chart, at the end of May as we come into June and talk about, yep, there it was. There's the consolidation. And it won't be until that point that I have on the screen until we'll be able to actually make any directional decisions of any sort on an intermediate basis. Now, this is a unique channel because I have the database, which I'm watching nearly 15,000 symbols in the database. So it's always given me an edge on the emerging and the deterioration of trends. So as we were coming into the end of last year, we were seeing a lot of things starting to drop off. We saw the intermediate database drop off. We saw the short-term database. So there were signals as we came into this year that this thing was going to soften up and that we were going to get some kind of correction. And like I said in the beginning of the stream tonight, is we had a 52.5 compounded rate of return, 23, 24. Did you not think the market's going to go? You think, Donald Duck could have been the president and this would have happened. There's markets, when they get to this point, they're always looking for some reason to drive up, some kind of narrative. And the financial markets aren't any different than anything else. I mean, now you, I wish I'd saved this screen. I started to put this tweet out, but those of you that think the golden cross or the death cross is something, if you just go into ChatGPT and say, can you build me a track record of everything that's ever, I had this, I closed out the tab. I meant to post it because it just shows you how stupid and ridiculous most of the media is out there. When the 50 crosses the 200 like it's some death thing. It's like worked 5 times in the last 40 years, and it's just not something to hang your hat on. And there have been, of course, times where it worked really good, and everybody points to that. Look what happened here, but they're not high probabilities. And what in being involved in these markets is all about probability. So if you don't understand that, you're going to make a lot of really silly mistakes and you're going to hate yourself. You're going to look in the mirror and go, why did you do that? So if you find yourself talking to yourself in a market, it's you're not very let's say process oriented. So and we all get those kind of traits, but on a macro level, on a bigger scheme like this, patience will go a long ways. And I know there's people out there, do dollar cost averaging and you win, and you probably will, as long as the market always goes up every year. From 2000, let's see, from 08, it wasn't until 2013, there were 5 years there. Bear with me one sec. Yeah, so during those times, there was something called the lost decade from 2000 to actually 2013 before the markets were able to make new highs. So, there you can get in and out of the markets and add some stuff. At some stage, I will show you something. Yeah, S&P, yeah, 4,000. Who knows, Mike? Anything, anything's possible. But I do think we have a lot to digest. This whole situation that is going on with the U.S. and the tariffs and all that stuff right now. This is a material change, and this is why when I'm kind of trolling Paul a little bit, but in reality, nobody knows what the outcome of this is. Okay, and if you want to ignore that things are drastically changing, well, that's on you. They are changing, and they have changed, and I don't know where they're going. No one does. But we go back to technicals and the quantitative. I've been through the database that I show you folks every night was first built in 1998 was when we started that particular database. Technically, it was 96 on a. It was the same database, but it was rebuilt in 2008. But the models that are running, all these models that I have in there, they haven't changed since 92. So for 33 years, they've been functioning in the market. So they've been well tested in the trenches of the wars, and so they I have to admit, for years I sat around like, wonder when these things will stop working, and they're seated in some very solid basis on how they work. So they continue to work. Every time we go through one of these things, I'm like, well, did we come out of it okay? Whatever. But it continues to work. So they're very, very solid statistically. And I'm getting ready to do some things with AI and dig into and do some major data mining on that. But my point is here, a little lesson, is when you're looking at these markets, everything takes time, especially after you break the market like we did. Even though we went down last week, print a new low and snap back, that's a good thing, right? But now the markets have to consolidate and work through all of those. I call them disruptions in the patterns, right? When you get that big a move, it just takes, in the daily charts, it can take five or 6 days just to normalize that volatility again. On a weekly charts, it's 5-6 weeks, 2 months. It's just going to be that way. I see somebody, I think, on YouTube comments. I try to answer a lot of comments that are reasonable, or let you guys know I'm paying attention to what you say. So most of those comments I get are in the replay. So if you go back to the replay, those are good places to make comments. Even the live stream stuff is there, but sometimes that's the best place to go. But I'm kind of stuck in this loop a little bit. But my point is that this is a good lesson to pay attention to, and we'll see how this unfolds over the week. So I got a little deeper in there than I thought I would, but here we go. So let's go ahead. Plan is here. Let's look at the. Let's go to the 10-year real quick here, and same scenario. We'll stay with the weekly, but same scenario here on the 10-year. Volatility spike that we got last week. Now we got to consolidate. We're looking at, on the weekly, we're looking at the same scenario where all of that is going to collapse in. And, so the good news of this, if I bring back the indicators are suggesting that we're probably going to stay, and I set this up, I believe, last night. 395 is way, way low, but right now it's probably 420, 440. We probably work that range for a while. We probably stay at least above, that 420 is probably going to be rock bottom. Maybe it prints through it if there's some kind of an emotional event. We don't really have anything set up, I don't think, for next week. I haven't looked through the fundamental stuff. We still have earnings coming out. We got some of those things happening, but for the most part, the interest rates have this. All the markets are in the same scenario. You've got to let them play out, and I think just going back to some of the comments that Powell made about interest rates, they seem very nonchalant, very not excited about anything, and I don't think they should be, because if we look at the ranges of where the 10-year's been printing, I think there was a question asked by the interviewer was, all the other markets, the German, the Japanese bonds went down, but the U.S. bonds went down in yield, and U.S. bonds went up. And I've been talking about that, so that I still have that high water mark at 4.72. Above that is not a good thing. We've got some Fibonacci targets out there that, above 5%, that would not be a good thing. And that would also be telling you that for me, that's going to be a loss of confidence from that standpoint. But things have stabilized since last week. We even got, there's a thing, if you're new to the channel, these are the WaveTech market grid. Well, we closed outside of the range, and you can go through a lot of bars, and you'll see that very seldom does prices or yields or anything on any of these charts go outside of those ranges. When they do, RTX, which is the extreme projected for that week, we closed above it. We actually satisfied fib target 1 for like the 5th time. This has been kind of the cap. We've been a little bit above it. That range is roughly around 460. So we have been above it a couple times. Looking back, we spiked above there just a little bit. What was the high? 459 right to 460. So that price is a little closer to, actually that's 455-ish is where that line is. 456 to be exact. So we came in that range. Now we get the same kind of contraction, multiple weeks. So, like I said, I think this is, if we look forward as we go through the rest of this month and come into May, there's going to be some great range trading here on just about everything. So it's going to be a point in time where we're trying to normalize. Anything could disrupt that. There could be news outside the box, maybe the China-U.S. thing. There's some new development that could blow this up again. But for right now, we're just expecting this thing to consolidate. Normalize is the best word to use here from that standpoint. Where are we at in time? Yeah, this is kind of unfortunate. I'll go ahead and cover. Let's do gold real quick. I mean, the gold's just running so hard. Helps if I get the right symbol. Yeah, so this is weekly gold. I covered this yesterday. We already went above that first fib target, which was 34.46. Next target, 36.54. And I was showing you yesterday, if I bring this in, I mean, this is like the lines here that are dotted are forecasting the 10, 21, and 40 moving averages. So this is, you can see this vertical move. And unfortunately, I didn't get to the CPI numbers, but I'll do that in Substack tonight. So if you don't have Substack, kendallreport.substack.com. There's 7-day free trial and $8 a month. There's some other options there for you. But this is a vertical move. And the next fib target here, we've satisfied fib 1. Next fib target, 36.50. And you can see the red dot is forecasting the close. This is a weekly gold chart. So we're at best going sideways and holding around. Now that we're at, where we at? 33.57. We probably get, probably challenge 3,400 I think there's some lower charts here. Let me look at something here real quick. I think the daily has, daily has another forecast here on fib target 3460. So we'll look at 3460 as a big number, but really be cautious as from this thing. We got on the daily, we got an RTXL, so it says at least 1 to 2 days sideways, and sometimes that can end up being a top. So this thing's blowing off a little bit. Let's take a look at the PPMs. Yeah, according to this, we still have maybe some strength into next Tuesday, but be cautious. If you're not on this, be careful about trying to buy it up here. That's for sure. All right, just looking at a couple comments here. Let's go to Bitcoin just to cover it. Listen, I cover all this stuff in the Substack. That's the best place to get my micro analysis. But I think it's kind of interesting. The 200 still running up. This is daily. I think the weekly chart is like your best friend right now with Bitcoin. And when we look at this, I talked a lot about this last night. Same factors. We got the 10-week moving average right here. That's at that's at 92,700, and it's dropping about $500 per week. So that's going to be your first line to watch. If we break above that, then we're going to head probably up to somewhere. Just trying to look at numbers, 90, 92, maybe up against that 21-day moving average. So I'll come back up on screen here, and we'll take a couple looks at some of. Yeah, it is, Brad. It is. So Brad's saying the angle of attack on gold is just so bullish. It really is. Certainly, the issue though is even though that's bullish, you can pull back into these averages, which if you try buying up here, could get a little expensive depending on what kind of position you put on. But the patterns that we're looking at there are definitely bullish. Probably going to see 36 plus. Yeah. So let's see here. I'm just looking here at a couple of comments, and then we'll. Yeah. So let's just summarize tonight. That I think it's pretty obvious that nobody has a clue about how these tariffs are going to play out. No one knows anything. Okay, I don't. Nobody does. All we've got right now are some of these technical quantitative tools. I can tell you that from the database standpoint, the reason why I go through that, we're fully liquidated there. I mean, we got 14% on the dailies, and then on the weeklies we're at 18%. That means basically 2 out of 10 symbols out of 15,000 have trending characteristics, and on a short-term basis it's fewer than that, right? So the reality is there is no there's no structure, there's no participation. Can you get lucky and buy a low? Sure, but we don't know what we're going to have to digest from the standpoint of what happens. I mean, this is really, and I put this out here the other night, is what we're looking at is really an economic war with China. So we're going to find out what everybody's made out of here, and so it could get really interesting, especially with I talked about China having the bond sale, where they've got as it turns out, they've got other tools. They got the rare earths. They've got other things that looks like they're willing to use. So it's not just bonds. It's much, much more. And we'll see how far this goes and who folds the cards, and what comes out of it. So hopefully what comes out of it, that it is a good negotiating tool. And, let's face it, China's been ripping us off. They take our IPs. I think it was interesting that Mr. Wonderful is probably one of the biggest spokesmen because he's done a lot of business over in China and has been ripped. And he's claiming that there's 1 million entrepreneurs in the U.S. that have had their IP ripped off and then remarketed under another name on Amazon, right? And so we'll see what happens. Hopefully good things come out of this. And, for right now, my analysis and summary of what we talked about tonight is really just that we're in this consolidation phase and we're in this wait and see. Prices are going to have to normalize after the volatility that we've seen. We've already normalized on a daily basis. Now, next phase is that weekly charts that I showed you. And then once we get through that, then we'll be able to determine, directional move on a larger scale. Right now, we're locked in. That's, like I said, anything can happen. There can be big news. I would suspect, I'm not even going to put that out there. I was going to say I suspect the big news, any news could be negative, but it can be either way. I mean, you could get, China and the U.S. coming up with some spectacular deal, and all of a sudden this is all over, and the entire trade of the world has been restructured, and we all see it as optimistic and wonderful, or it could be the opposite. So I'm not even going to put that out there. Right now, we're in that consolidation range. I think somewhere around June, it may roll us out to the next quarter, might be Q3. I still have expectations of some sort of negative GDP coming into year end. So and that has some to do with the tariffs, but it has more to do with things that have already happened and digesting all of the excesses of the massive immigration, the massive amount of dollars that have been thrown into the markets and inflated. So I was talking to somebody, and if you're complaining that the market's off right now, you weren't complaining last year when they were pumping it, right? So everybody likes the pump, but now you need to take some money out and normalize things. We're even seeing this normalization on a larger scale. Maybe I can bring that up with some monthly and even quarterly charts. I think we've gotten very, very frothy without any big, we have to go back to 22 to get into some kind of corrective phase. So anyway, I'm going to stop it there. But I appreciate, we had a lot of folks on the stream tonight, so I appreciate everybody watching. Get the Substack. If you don't have a heck of a time to do an advertisement, but if you're still hanging out, if you want the indicators, you can go to kendallreport.com/indicators24, and then I'll put all this stuff in the description as well. And then the Substack is kendallreport.substack. We've been getting a lot of signups lately, so that's good. Keep going. I put that out every day. So, and it's pretty robust. I mean, it ends up to be 2,500 to 3,500 words. And I'm having an issue. I'm trying to figure out how to get above it. I was trying to add gold in last night. So what I did last night is I put in the gold fact sheet. So hopefully that's helpful. The problem with Substack is there's an email limit. It's actually so many characters you can put out with and size of the email. Well, once I try to do one more thing, you're going to have to go on to the Substack app or onto the Substack website to get it, because a lot of the stuff people have signed up for their email. So you're going to get truncated at the end. So I'm trying to figure out the best way to deliver more information. All right. So once again, thank you. Hit the like button before you leave. And I will talk to you next Sunday night. All right. Have a great day.